Welcome back to the deep dive. Today, we are taking a privileged look inside the operational strategy of a major investment committee. We have a blueprint in front of us.
Right, a real blueprint.
Exactly. A highly specialized report that pretty much ignores the daily headlines and focuses entirely on deciphering the pre-market tea leaves of futures trading. So we're talking ES, NQ, and RTY.
And what makes this dive so crucial right from the start is this core paradox that the strategists are wrestling with.
Okay.
On the surface, market sentiment is, well, it's remarkably neutral. The news flow is moderate. You're not seeing extreme fear or euphoria.
Oh, just quiet.
Deceptively quiet. Because this entire 40-page report is dedicated to finding the subtle shifts, the underlying anxieties, and the genuine fragility that's hiding just beneath that facade.
So the goal isn't to follow a trend, it's to anticipate when that apparent neutrality is going to just shatter. Our mission today is to understand how these top-tier players sniff out the danger before it hits the 9:30 a.m. open.
Precisely. They know that if you're just relying on macro news, you are always playing catch-up. And because the environment is, and I'm quoting here, devoid of strong directional catalysts, their focus becomes almost forensic.
Forensic, I like that.
Yeah, they narrow down to three key areas: how liquidity structures are manipulated, what volatility dynamics are secretly signaling, and where correlation breakdowns are exposing the real weakness in the market.
That makes perfect sense. If there's no clear catalyst, you have to hunt for the mechanical friction. Okay, let's unpack this and start with what sounds like the most dramatic part of pre-market trading. The high-stakes game of liquidity grabs and this trapped trader scenario.
This is where a lot of the price action is, well, it's basically manufactured. Pre-market liquidity, that period from roughly 4 a.m. to 9:30 a.m. Eastern is just fundamentally thinner than the main session.
And that's the vulnerability.
That's the vulnerability that this is exploit.
When you say thinner liquidity, what specifically are traders looking for on their screens to confirm that, the water's shallow?
They're looking for two primary indicators in the order books. First, the most obvious sign, wider bid-ask spreads.
Okay, the gap between the buy and sell price.
Exactly. And second, and this is maybe more important, they look for shallow order books.
Okay.
So very low depth on the bid and ask sides for those futures contracts. If there are only a handful of contracts stacked up, it means a relatively small trade can push the price a long, long way.
And this is what leads to the liquidity grab. This is where institutions don't just react to the market. They intentionally engineer a momentary panic. How does that actually play out?
It's all about clearing out the stop-loss clusters. Institutions have a pretty good idea of where the masses set their stops, usually just below a significant overnight low or, just above an overnight high, or maybe a pivot point like the previous day's close.
Sure.
So they execute what the report calls overnight probes. They'll drive the price briefly past that level with just enough volume to trigger all those stop-loss orders.
They trip the wire, so to speak, and just vacuum up that cheap inventory.
That's it. They trigger the stops, which gives them the liquidity they need. But here's the critical move. They immediately reverse direction. They fade that initial probe.
Oh.
So traders who bought that brief breakout, thinking a sustained move was starting, are now completely caught on the wrong side. They become trapped longs or trapped shorts.
So if I was a buyer on that initial spike, I'm now watching the price just plummet against me. What do I do?
You're forced to cover, usually at a loss. And when hundreds or thousands of those trapped traders all cover at the same time, they're selling or they're buying, if they were short, provides this powerful acceleration for the real move the institutions were planning all along. It confirms the false breakout.
Let's use the tech-heavy NQ, the NASDAQ futures, as a clear example of this.
Okay, so imagine NQ futures rallied hard overnight. They pushed just above resistance, say at 18,000, but it's on really low volume, and then it just stalls. Early morning traders who bought that 18,000 breakout. Well, if the price then sharply reverses back down towards 17,950, those initial buyers are now trapped longs.
You're stuck.
They're stuck. And when the institutional money starts selling for real, those trapped longs are forced to liquidate. And their selling just fuels a cascade. It drives the price even lower, the exact counter move the smart money was waiting for.
It paints a picture of just extreme strategic patience. These key overnight levels, they aren't just guideposts. They're known psychological pivots where institutions can lay these traps.
And that's why the report places so much emphasis on defining the implied opening range before 9:30.
Okay, so how did they do that?
They use two main methods. First is options-based implied volatility, or IV, to estimate a one standard deviation move for the day, and the second is just applying a multiple of the average true range, the ATR, over the last 5 to 10 days.
This calculation basically gives them goalposts for the day. It helps them differentiate, genuine conviction from all that manipulative pre-market noise.
It provides context. Exactly. If the market opens way outside that calculated range, you know the conviction is extreme. If it stays within it, well, the pre-market action might have just been stop-loss hunting.
That brings us directly to volatility. If the overall sentiment is neutral, you'd think the VIX, the market's fear gauge, would be pretty docile. So why is the VIX term structure so vital right now?
Because the VIX level itself, say a calm 17, is only one piece of the puzzle. The term structure tells you where the anxiety is hiding in the timeline. We need to look at the relationship between VIX futures prices and their expiration dates.
Okay, let's clearly define the VIX futures curve, because this is often where the jargon can trip people up. What's the normal state of affairs?
The normal state is Contango. This means that VIX futures expiring, say, 6 months from now are more expensive than the ones expiring next month. It's totally normal.
And it suggests things will calm down over time.
Right. It reinforces that neutral sentiment because it suggests that, yeah, while we might have some volatility today, the market expects things to calm down and revert to historical averages. It's basically the cost of longer-term insurance.
And a red flag. When does that complacency unwind start showing up in the structure?
It's when it flips into backwardation, or at least a severe flattening of the curve. Backwardation means the nearest month VIX futures are more expensive than the further out months. Think of it this way. The price of protection today or next week is suddenly higher than the expected price of protection in 3 months. That is the definitive signal of immediate, urgent demand for protection. It tells you professional traders are genuinely panicked about a near-term event, no matter what the news anchors are saying.
That's a very clear marker. And the report points to some specific evidence of this kind of localized anxiety in the options market, particularly around tech stocks.
Absolutely. So while the VIX has eased from a recent spike above 26, the specific data point that grabbed institutional attention was the widening of the QQQ-SPX implied volatility spread to a one-year high.
So the cost of insuring against a drop in the NASDAQ, the QQQ, versus the S&P 500, the SPX, has widened significantly. What does that spread tell us?
It reflects intense, localized tech angst. Traders are highly concentrated, and they're highly worried about the valuation risk in the mega-cap AI sector. They're willing to pay a much higher premium specifically for protection on the tech-heavy NASDAQ.
So it isn't fear of a general slowdown.
Not as much. This divergence suggests the market doesn't fear a general economic slowdown as much as it fears a sudden violent correction in just a handful of those high-flying AI stocks.
So if liquidity is thin and the fear is localized in tech valuations, where are the big money flows actually going? This leads us to the correlation chaos when those traditional relationships between assets start to break down.
Yeah, the report highlights this classic divergence among the core indexes. When NQ is leading a rally on low volume, but ES is lagging behind.
It screams narrow market rally.
It screams narrow market rally. That concentration in specific AI and tech names makes the entire move fragile. It's susceptible to a really fast reversal.
And RTY, the Russell 2000, which holds the small caps, that acts as the internal barometer for the health of the broader domestic economy.
That's its crucial role. If RTY is showing genuine weakness, let's say small caps are down 1% while NQ is up 1%, it signals these underlying concerns about corporate fundamentals and risk appetite. It suggests a flight to quality is happening, but only within the biggest companies, bypassing the small businesses that really drive growth.
Now, for what I think is the most specific aha moment in this source material, the gold versus Bitcoin story. For years, Bitcoin was called digital gold, but that relationship seems to have just dissolved.
The correlation has significantly frayed, especially here in 2025. Gold is firmly back in its traditional role as a safe haven asset. It has shown resilience, significant strength. It's up a massive 56% year-to-date as of September.
So it's attracting those traditional crisis flows.
It is. During any period of uncertainty, that's where the money goes.
And where did Bitcoin end up in this paradigm shift?
It has firmly established itself as a high-beta risk asset. It mirrors the performance of highly speculative growth stocks.
So not a safe haven at all.
Not at all. While gold held steady during recent market dips, Bitcoin experienced a sharp decline of over 21% in a recent month. The one-year rolling correlation between them has weakened to just 0.47, which confirms institutional investors just don't view it as a reliable crisis hedge anymore.
So when the report observes that everything from gold to Bitcoin to AI stocks corrected on the same day, that isn't about fundamentals anymore. That's about systemic liquidity forcing everyone to sell at once to raise cash.
Exactly. When liquidity evaporates, portfolio managers are forced to sell whatever they can that's profitable or liquid. It doesn't matter if it's supposed to be a safe haven or a growth asset, the selling becomes indiscriminate, and that is the hallmark of a major liquidity event.
Let's pull the lens out to the macro drivers that are sustaining this fragile risk-on tone. What narratives are currently fueling the rally, even if institutions know it's thin?
Well, we have two really powerful narratives at play. First is just overwhelming AI optimism. The market's been revitalized by the announcement of Google's Gemini 3 AI model.
Right, that caused huge gains.
Massive gains. We saw Alphabet up over 6%, Broadcom up over 11% after that news. It provides a credible future growth story that the market can rally behind.
And the second driver is all about anticipating monetary policy, this dovish Fed expectation.
Correct. The market is pricing in a massive 80 to 85% probability of a 25 basis point rate cut in December. This is based on perceived dovish signals from officials like New York Fed President John Williams. So the expectation of cheap money is underwriting current valuations.
And this all leads to the institutional conclusion. The high conviction thesis is that the market's neutrality is a deliberate self-deception, and it's masking a potential complacency unwind. What is the biggest mispricing here? The primary pain trade that would cause the most violent shift.
The primary pain trade is the failure of the Federal Reserve to deliver on that massive expectation. If the Fed disappoints, if they hold rates, or if they adopt a significantly more hawkish tone than that 80% consensus is priced for, it would cause a sharp, violent unwind of nearly all current positioning in risk assets and in fixed income. The market is just positioned way too heavily for dovishness.
And the secondary pain trade relates directly back to that localized tech anxiety we talked about.
Yes, that is the overcrowding and overvaluation in AI mega-cap equities. These stocks have become the only growth vehicle for so many funds. If there is a material slowdown in AI spending or unexpected regulation, the valuation correction in that narrow group would be profoundly painful, and it would probably drag the entire S&P 500 down with it.
This entire deep dive has really shown us that institutional strategy isn't about tracking the CPI report. It's about anticipating these liquidity traps and structural flaws. And speaking of structural flaws, we need to talk about the final, most critical insight from this report: the paradoxes of systemic liquidity.
This is a critical nuance that often gets misinterpreted. The report identifies two massive friction points that could trigger the next systemic shock, regardless of what the Fed does in December.
Let's start with the money market funds, the MMFs. This $7 trillion pool is always cited as cash on the sidelines, ready to rush into stocks. But you're saying that money actually drains liquidity when it's deployed?
It sounds counterintuitive, I know, but yes, it often creates friction. When people park money in MMFs, they're parking it in highly stable, short-term debt instruments. So when that capital is pulled out of MMFs to buy stocks or corporate bonds, it means money is moving away from safe, liquid holdings and into less liquid, riskier assets.
So when that $7 trillion starts moving, it doesn't represent new cash coming in, but a shift of existing cash out of the safe system, which paradoxically reduces the overall free cash in the broader market.
Exactly. It's parked liquidity. When it flows out, it creates systemic friction. It amplifies risks by reducing those buffer reserves right when risk assets are accelerating.
What's the second, more immediate structural risk they flag?
That is the anticipated liquidity storm driven by the schedule of Treasury settlements. The report highlights that a massive $150 billion in Treasury settlements is scheduled over just 5 trading sessions.
Wow.
That's an enormous requirement for cash.
And where does that cash come from?
It has to be drawn from somewhere. It's pulled directly from bank reserves and, critically, from risk assets. This immediate high-volume cash requirement acts like a huge mechanical drain on market liquidity. It contributes directly to the kind of indiscriminate selling we talked about, pushing down everything from the S&P to Bitcoin, even with no bad news.
This really recasts how we should be viewing market stability. It's not just about what the Fed is saying, but about the physical mechanics of cash flowing in and out of the system.
Institutional strategy right now is all about managing these liquidity risks. They are anticipating the friction from MMF deployment and the pressure from Treasury settlements, because those events often dictate short-term direction, completely overriding the fundamentals.
This has been a complete education in reading the fine print. You now know that top-tier institutions are anticipating traps, watching for the VIX term structure to flip into backwardation, and recognizing gold and Bitcoin are no longer behaving as partners. The underlying takeaway from you is this. The market's stability is an illusion, threatened by deep mechanical movements of cash you just can't see in the headlines.
The key is observing how these hidden liquidity flows, particularly the need to settle those huge Treasury issuances, rewrite the short-term rules of the market. Keep watching those levels and recognize that the next big shock might not come from a news agency, but from a Treasury settlement calendar.
A truly provocative thought. Thanks for diving in, and we'll catch you next time for the deep dive.